Good afternoon, ladies and gentlemen. Thank you for taking the time out of your busy schedules to join our webinar today, as we discuss the various problems facing expats across the globe and how we can best manage some of these situations, as well as offer up some solutions to some of these long-standing issues along the way. I'm Cam, the financial analyst here at Dunhill Financial, and I'll be your moderator for this afternoon. We'll be putting everyone on mute as soon as the presentation begins. However, please feel free to ask questions in the chat during the presentation. We will also be having a dedicated Q&A section towards the end. Just before we get started, a few disclaimers to go through for compliance purposes, so just bear with me. Information presented here is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments may involve risk and unless otherwise stated are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategies discussed. With that out of the way, I shall hand it off to Brian.
Thank you, Cam, and welcome everybody on a very special inauguration day as we see Trump walk out of the White House, and we're only a few hours away from Biden's inauguration speeches. I think it's a very, very American day. So why don't we talk about how we deal with Americans? We'll start with an analogy, and one of our favorite analogies of how to deal with any situation is by the famed economist Takeru Kobayashi. Now, most of you probably don't know him as an economist, but he is a studied economist, and that's how he got to thinking that way. But what he's most known for is actually becoming the hot dog eating champion of the world. Being the hot dog eating champion of the world is not a small feat. It used to be that these big, large guys would try to figure out how they could eat as many hot dogs as they could in 10 minutes. Kobayashi changed the equation, and he changed it to, how can I most efficiently eat one hot dog and replicate that as many times as possible? He separated the hot dog from the bun, cracked the hot dog in two. He was then able to actually swallow the hot dogs full and use a little bit of olive oil to be able to let the bun go down without having to chew it in any way, shape, or form. These masses of efficiency got him up to actually 72 hot dogs in 10 minutes, which is an amazing feat. And that's what we want to talk about here today, is how we can look at these problems and these issues, turn them into opportunities, and manage American expats' finances in the most efficient ways. We're going to cover a lot of subjects today, from all these acronyms, FATCA, FBARs, PFICs, and the such, to where we can use banking accounts and investment accounts, Social Security, currency exposure, estate planning, and some of our different solutions and different resources. So while we're presenting this, please make sure to use the Q&A function if you have any questions. Cam is on hand to answer any questions, and then any of the ones that we don't answer during the presentation, we're going to go ahead and take those at the end of the presentation. So please use that. Please use the chat function. We want to make this as dynamic and as fun as possible as we navigate this great big maze.
John Burrow once said, "A man can fail many times, but he isn't a failure until he begins to blame somebody else." Despite these wise words, we are in the age of Trump and Brexit. Therefore, let's start to point fingers.
Most all American expats have had many negative ramifications from the Foreign Account Tax Compliance Act, also known as FATCA. In fact, it might have led to the closing of your brokerage account in the United States, or even your non-US bank telling you to go elsewhere.
So it's Obama's fault, right?
Not exactly. When you follow along with FATCA brought about, it's really introduced ways that American expats could get caught while not declaring taxes, owning PFICs, or even not declaring taxes that were owed.
So if Obama just built a means to catch non-compliant individuals, why did everything change for expats in 2010?
Well, rules from past presidents started to be enforced. Ronald Reagan, the beloved president that was in favor of cutting taxes, added a huge tax to American expats with foreign investments with the introduction of PFIC rules, also known as passive foreign investment companies. These were designed to prevent Americans from owning managed vehicles from foreign jurisdictions.
So what about the notorious Nixon?
In 1970, Richard Nixon signed into place the Bank Secrecy Act, and American expats had to report all foreign bank accounts that aggregate to over $10,000 US. They have subsequently never increased this amount to meet inflation growth. If you haven't provided these documents, they can lead towards large fines. All the while, no tax is ever owed on these declarations to the Treasury Department. Until FATCA, Nixon and all subsequent presidents had no means to police the foreign banks and to enforce the rules.
For the sake of pinning the blame for the frustrations behind being an American expat, we blame Abraham Lincoln.
Lincoln may have abolished slavery in the United States, but made any American that moved out of the country de facto slaves, of which no other country other than Eritrea follows the logic, and even Canada has banned them from being able to do so. Abraham Lincoln introduced citizens-based taxation with the first income tax signed on August 5, 1861, and was a measly 3% of income to help fund the North in the Civil War efforts. All of the above culminated in what is now known as the FATCA Accords established by Barack Obama. This law was designed to increase the compliance of U.S. taxpayers that had reporting requirements for financial accounts that were held in foreign jurisdictions. To ensure compliance throughout the chain, the new framework imposed legislation onto both the individual and the financial institutions that service the U.S. persons. This led to the stricter reporting standards and larger penalties being imposed for non-compliance. With the newfound power in place, the FATCA Accords essentially became the international policing force for U.S. persons with foreign accounts and assets. With over 113 countries having signed up to comply with the U.S. FATCA rules, and an additional 200,000 plus institutions having registered with the IRS.
Now that we've pointed our finger just about everybody, let's start unraveling some of these different concepts. FATCA really came about because it was a true opportunity for the IRS to go after a lot of tax dodgers. And you can see between 2001 and 2008, those numbers got to astronomical figures, about 6 or 7% of the U.S. debt, the U.S.'s current deficit. So it was too big of an opportunity for them to pass up. And let's be honest, we have a bigger deficit coming because of this Corona crisis, and that is just giving these tax authorities more opportunity to go after tax dodgers in different ways. The problem is that when they go after the tax dodgers, it punishes a lot of these American expats. For example, back in 2009, when they cracked down on Swiss banking secrecy, 52,000 Americans with accounts at UBS in Switzerland, which is just a retail bank in Switzerland, had their accounts frozen. But most of those got closed, and there were only a few of them that were really tax dodgers. So we know that there are ramifications, there are problems that come about from these types of issues, and that's what we're really here to solve today. The main issues, like we said, was the FATCA Accords, and they collected a lot of taxes, and it's been here for a decade. So don't think just because we're seeing a bunch of articles saying we should get rid of FATCA that it's going anyplace. It's probably here to stay for a long period of time. So let's unravel what it really is. What it really comes down to is it's a law that states that any American that's sitting abroad has to have their information shared back with America. And under these, you have different tiers of countries, some of them in which the financial institutions have to report back, others where the national bank has to. But regardless, there's a responsibility to report that information back to America. It gets reciprocated that America is supposed to share that information with the home country if, say, a European has an account in America. Hasn't really come to fruition with that. But it affects a lot of people, and a lot more people than just people that have an accent like mine. It naturally affects all US citizens. But if you're a non-American and you live in America, everything we're talking about affects you. If you're a green card holder, but you're not currently living in America, but you still have a green card, you're just the same as a US citizen. And these all apply even if you have a second citizenship. I can't just decide because I'm also British that I'll use my British passport to bypass all of these FATCA accords. So make sure when you're talking to your clients that it affects just any of those people that fall into that. Now, it goes beyond just tax reporting. And with those tax reportings, you have, or the non-tax reportings, you have something called an FBAR. The FBAR is so instrumental to get right because there's no tax owed just for declaring these accounts, but there's heavy penalties if you don't declare them. This has been around since the Nixon era. And one of the biggest problems is that they didn't actually build in an inflation hedge to increase the 10,000 minimum. And the 10,000 minimum to declare is all of your accounts in aggregate. So if you have 10 $1,000 accounts, you have to declare all of them. If you have one account that stays under $10,000 all year long, you're fine. So some people strategize by just keeping small balances outside of America so that they can avoid doing an FBAR reporting. But the FBAR reporting isn't all that hard. It's just cumbersome to go through because you have to get that high watermark, i.e. the highest balance over the course of the year. There are some exceptions that seem to be changing right now. A lot of people are talking about cryptocurrencies, and some people have even called us asking, can I bypass FBAR reportings by just investing in cryptocurrencies? The answer right now is yes, but probably not for long. Same thing for internet poker accounts and foreign pensions too. You have some accountants that report them, some accountants that don't. It's very hard to report them because it's hard to get the underlying information. And now, if you do over-report information, it's probably better than under-reporting, but there's no clear information of whether they should be included or not. A controversial area that a lot of Americans that have been here for a long period of time fall into are PFICs, passive foreign investment companies. If you never have to deal with a PFIC, you will be a happy person. And that even includes where you have some of these investment advisors that are going around saying PFICs are fine, just take the QEF election. It's still a heavier tax to the American expat than it would be for them just to invest in the United States. So any type of structure, investment structure that's built outside of the United States falls into the line of being a PFIC. That even includes an exchange traded fund. You can buy exchange traded funds in New York on the US stock exchanges, but if you buy them on Frankfurt, the London Stock Exchange, or any other stock exchange globally, even though it might be even owned by a US company, it's going to be completely different, and therefore it's going to fall in as a PFIC. In the resources, what we'll do is we'll actually include some accountants' views on PFICs, because we're not tax specialists, we're not pretending that we are, but we've never talked to a tax professional that actually thinks a PFIC is the right move for any clients. So we're going to show you how we can take care of those. And the easiest way to take care of those is have your bank account in your local country, but have your investment accounts back in the States or with a carrier that only owns them back in the States. There's 5 big reasons why you want to do this. Well, the first one's the taxes. Your taxes are going to be a lot lower if you avoid PFICs by every single cost. I've never heard that disputed, and that is the easy way to lower your taxes as an American expat. Secondly, the documents. You automatically get a form that's called a 1099. The 1099 is the declaration form, and a lot of tax software actually allows you to just upload that information directly into your forms. So it saves a lot of time and aggravation. Third one, FBAR. If you keep your accounts in the United States, you don't have to fill out an FBAR for that form because it's already disclosed in the United States. The fourth one is safety. Now, this to me is important. Americans, especially when it comes to the world of finance, know how to fail. More recently, in 2008, we had the failures of Bear Stearns and Lehman Brothers, and any of their retail clients didn't lose a dime. They just got moved over. For instance, Lehman over to Barclays, Bear Stearns over to JP Morgan. All their securities were separate from their balance sheet. We don't have those same structures all around the world. We had some small island European problems less than a decade ago where everybody's accounts got stripped to 10%. So having those structures of SIPC, FDIC, having the segregation of assets if you don't have your money on margin, these are great things to institute confidence in all of your clients. The last one is the all-important fees. Fees on most financial instruments in the United States are so much lower than they are in many European jurisdictions. As many of you will know, most of us pay to get on platforms here in Europe or in the United Kingdom. Whereas in the United States, most platforms are free and we only pay a transaction charge or other means. Think of these Robinhoods where younger investors are getting online and investing for free, no commissions, et cetera, et cetera. Most of these structures start in America, so it's a lot cheaper. So you're giving a value proposition of why they should keep their investments in the United States. Now that becomes really quite the good reasoning behind keeping your investments in the States. But if you just put it into a Vanguard account or most of the other institutions, they're going to have an overexposure to US dollars. Now, if you're doing something more short term and we are buying a house or starting a business or some other big investment in the next couple of years, we're just going to use future contracts, forward contracts, options, and swaps to go ahead and hedge that currency risk, that near-term currency risk. But if we're talking about retirement in 20 years and then 30 years of retirement thereafter, that'd be a very expensive way to manage our currency risk. So that's when it comes into natural hedges. We'll have a little fun with currencies first, and then we'll go into natural hedges. All these videos are available directly on our YouTube site and great pieces to put out in front of your clients to explain some of these concepts. Because something like natural hedging becomes a little bit more complicated for a typical investor to understand. But the simplicity of it is that over half of the world's market cap in companies are US companies. Now, your typical portfolio in the US will be 80 to 90% allocated to US securities. Now, this is simple. If you buy the majority in your home currency and you retire in that currency or you need the funds in that currency, you've reduced one risk in currency risk. A European bank or a British bank will do the same thing. You can see that the United Kingdom makes up just under 4% of the world's market cap, and yet a portfolio will be 40 to 50% British pounds for most institutions here. And by doing so, they've minimized that GBP risk. Well, what do we do for natural hedging? We'll get to that. But where is the world of currencies? We started off the presentation talking about hot dogs. It's an all-American day. It's only natural that we move on to hamburgers. And as an economist, we're naturally going to play with the Big Mac Index, which is a tongue-in-cheek approach that the economists came up with to evaluate PPI, the Purchasing Power Index. When we look at the Purchasing Power Index, what we really see is that over the last couple decades, we've gone from the dollar being really undervalued to being overvalued compared to most countries. It doesn't matter if we're looking at developed countries over on the left or emerging countries over on the right. The US dollar is basically one of the most expensive currencies. Well, how did we get there? Well, we went from essentially a period after the financial crisis where there were 7 currencies that were strong and weathered the storm better than most everybody else. And so therefore there was a flight towards safety. These were the US, Canada, Australia, the UK, Switzerland, Sweden, and Norway. You flash forward to 2014 and we had that commodity shock. So naturally Australia and Canada fell off the balance and were no longer safe havens as strong currencies. Naturally, Brexit in 2016, all the way through December 31st, decimated the pound and took them out of the equation, leaving us with 4 strong currencies: Sweden, Norway, Switzerland, and the United States. The first 3 being quite small countries and quite small financial structures. Most of that money flowed into the US dollar, which has led us to a position where we've had over a decade of dollar strength. So having a bigger portfolio of US dollars has come to the advantage of most Americans. And you'll notice in most of our portfolios, we've actually outpaced our benchmark. And this is why we've had an overallocation to US dollars. But since August, we've seen a turn in currencies. And we'd expect that to be a longer term trend. And therefore, it's the perfect time to be talking to your American clients that have US-centric portfolios, that have old 401ks or any of those types of things, and explaining to them while converting that natural hedge to the currency of where they're going to need the money is going to be more advantageous in the next decade. That's that natural hedge component. Now we have several portfolios, platforms that we can utilize. We have a wonderful platform that's through an international company that allows us to access ISAs and SIPs. So if you have a UK client and they want to take advantage of the UK structures, we can help them by setting up those US structures inside of there. If you have old 401ks, simple IRAs, SEPs, 403bs, any of the qualified plans, retirement plans in the United States, we can roll those into IRAs with our US providers, and we can help you manage those. Now, all of these vehicles give us a low cost ability to get into the market that produces your 1099s. It makes sure that you have a simple approach with no entry or no exit fees. We break down our portfolios into 3 different regions. Those are the natural hedges. So if you've got a client that's over in Europe and they plan to move back to the US, you should really be using the US dollar portfolios. But if they're going to retire in Europe, you should be using the Euro portfolios. UK, naturally, GBP. We break them down into 6 different risk parameters, conservative to aggressive growth. And naturally, we can help you slot those, although we have our own risk metric software. These are the baselines of what currencies you would own in the different groups. So this is, for example, the Euro moderate growth model, Euro moderate growth. And if you take a look at that, you can see across the board that America goes from 50% to more like 75%, down to 40% from Euro all the way to GBP. If you go directly to our website, and you'll be sent this presentation right after this webinar, you'll be able to go to our website and you can get access to all of our 2-pagers right on there for each of the portfolios. We're happy to say that we pulled all the performance through December 31st, and we were very happy to see that all of our portfolios continued to outperform their benchmarks this year.
Did you know that human beings are twice as concerned about avoiding losses than they are about achieving potential gains? That's one of the reasons humans tend to sabotage their own investing. Selling when they get scared, missing the recovery, and buying back in when the markets feel safe again. That's why your advisor uses Riskalyze. It all starts with a risk number, a quantitative way to pinpoint how much risk you want, how much risk you need to take to reach your goals, and how much risk you actually have in your portfolio. The results are powerful. So how does this work? First, we need to pinpoint how much risk you want. The old way, stereotyping investors based on their age, just doesn't work. Because everyone is different, your advisor may use a questionnaire or use a discussion of portfolio risk to set your target. Once we determine your risk number, we'll set up your portfolio. Your advisor uses your portfolio's risk number and 95% probability range to set expectations for what is normal for your portfolio. Keeping track of your investments this way helps you to understand that any 6-month result that falls within the range is right on track. This enables you to give yourself permission to hang in there, even if markets are volatile. You're going to love how Riskalyze empowers you to become a fearless investor. Let's get started today.
Now, as you can see, we use a fintech for our risk assessments, and we love this tool. You don't have to use ours. You can use your own questionnaire and slot the different clients in the different places. Where a lot of Americans like to use this software is that they can get their number, and then we can slot what their current investments are at their old firm to see where they are, where they say they are, and maybe where they should be. So it's a nice talking point. But feel free to use ours, test it out. You can get your own personal number and see if that works well for you. Planning for Americans goes well beyond just the little basic things like how to set up the investments. You saw how easy we can structure that to make their life easy and get it into the currency that they need. But estate taxes start to become much more cumbersome when you're looking at multiple jurisdictions. And we're going to be looking at different situations where you might get hit with double taxation when it comes to certain jurisdictions. And if you get a client that buys property in a third country that doesn't have a DTA for estate taxes, you could actually have triple taxation. So this becomes very, very interesting because Americans are very used to not having estate tax issues. If we look at the United Kingdom, all of a sudden, your thresholds go from 11.5 million all the way down to 325,000. And we're having to work with both sides of that. On the American side, you're still at 11.7 million. I'm sorry, I just said 11.5. I contradicted myself. But that's not always the case because, first of all, it doesn't work if you have a non-US citizen spouse. A lot more planning goes into practice on those types of things. And then you have to use gifting allowances to minimize those. So make sure you're paying attention to those. Make sure that you're not just saying, go ahead and gift all the money to the non-US spouse to get it out of the US, because you're going to get hit with a provision if you gift more than 159,000 US dollars in any given year to a non-US spouse. So you have this context that you have to play inside. A lot of Americans will want to buy property abroad. Now, in times where the dollar was going up, this hasn't been a problem, but there's some obstacles now that the dollar is potentially going down. So we'll go through some scenarios there. We love when Americans use mortgages because mortgage interest in the United States is still tax deductible, all the way up to $1 million on the primary and $100,000 for a home equity line of credit. So that can be a sizable amount of interest to reduce their taxes. On top of that, if you use it as a primary residence, you can deduct up to $250,000 worth of gains for each individual. So for a married couple, that could be $500,000 worth of capital gains that you won't have to pay taxes on a primary residence. Some things that you need to consider when it comes to American expats that they're used to back in the United States is that you can't use a 1031 for an international property. So in America, if you buy one property, you can go ahead and sell that, buy another property, and carry over the cost basis. This is not something you can ever do with an international property. You also can't use your IRA to purchase a property. So this means that somebody that has all their money in pensions and qualified plans really might be asset rich, but cash poor. With global transparency, not reporting something back to the US government becomes harder and harder. This is where we're talking about FATCA. Each government in Europe and mostly around the world has to report that back to the United States. Then the last part is that the house is separate from the mortgage, and we have to take into account foreign currencies. So I'm going to explain this by going through an example. And I'm going to say that we get a nice villa down in Tuscany. We buy it for 5 million euros. So that would come out to the equivalent to the US tax man as 5.9 million US dollars. Let's just say several years down the line, we sell the property, and we still sell it for 5 million euros, but the dollar decreased. And so therefore, that's really worth $6.5 million. Well, now all of a sudden, even though we bought it and sold it for the same price, just because of the currency movement, the US tax man is considering that you made a $600,000 gain. That's a significant gain that you owe taxes on. Now, on the other side, if we have the mortgage of 4 million, comes out to 4.7 million US dollars, and then the euro increases by 10% to the US dollar, now that's 5.2 million euros. Now, that would be a $473,000 loss. The problem is you can't offset that mortgage against the real estate property. So you have to pay the full tax on the $592,000. This hasn't been something that American expats have had to worry about in the last decade because of the strength of the US dollar. But now as we go into weakness, this can be the biggest savior that you have for your clients, not to scare them away from real estate, but just to make sure they're aware that if they're going to invest in something for a shorter time period, that they could have a large currency risk for it. A few other things just to cover in periphery. Social Security. Now, a lot of American expats will be scared that they'll lose their Social Security because they move abroad. That's not the case. Even more so, if they didn't reach the 40 credit hours and they worked in foreign jurisdictions, there's a lot of different totalization agreements that basically mean if you lived in most European countries and the United States, you didn't get 40 credits in the United States, you'll still get a proportion of your US Social Security. You have to let the US Social Security office know that you worked in those foreign jurisdictions. They won't assume so. So a great thing to let your clients know that they should be contacting the Social Security Administration, filling in those holes to make sure that they get every bit of a benefit that they could receive. On top of that, you're able to actually receive your Social Security check in your currency, your home currency, and sent to your local bank account. You don't have to have it sent to a US bank account and then figure out how to get it over. And this can save a lot when it comes to currency conversion costs, as we know. We know that we're not the only American expat financial advisory firm out there, and so what we'd like to give you is just a checklist of things that you should be asking any firm before you work with them. The first one is whether they're fiduciaries. We have a great video, if you click on the link, on what exactly a fiduciary is. But also, if you want to have a little bit more fun with it, John Oliver, the comedian, the English comedian in the United States, has a great bit that if you put John Oliver retirement planning in YouTube, you'll get a 20-minute satirical version of what fiduciaries are. Fiduciaries basically are always sitting on the same side of the table as you. They're always acting in your best interest. And this has become a big rally cry in America. Nearly half of the financial advisors are fiduciaries, and more clients are asking for it. The most important aspect of being a fiduciary is that you're not receiving any fees or commissions from anyone except for your client directly. This means that essentially you are always recommending what you feel is best for your client instead of what's best for you. Americans are very interested in talking about fees. So we're just giving you the basic analysis of the different companies. The lowest fees that we've seen are some robo advisor planners, which we have a robo product. So if you have a client that just needs the investment setup, no financial planning, we're at 50 basis points. They go in that range. And the highest fees that we've seen of any of the firms is 2.8%. We don't understand how you could make client money charging nearly 3% in fees. The average is right around 1.24%. Our highest fee in our schedule is 1%, and that's just because that's the equivalent of what a C share pays in 12B1 fees in the United States. And I don't feel that we should be charging a client more just because we're transparent, being transparent. That to me is not being a fiduciary. But then again, that's just our internal decision. You want to make sure whoever's offering the advice is regulated in the United States through the SEC. And this can be found directly on the BrokerCheck website. You also want to make sure that they're regulated in the country that they're giving the client advice, whether it be Europe, the UK. If they sell PFICs, it's impossible for them to be fiduciaries. So we would stay away from any company that is offering PFICs, even if they're stating that the QEF election is better. It's more expensive. And past performance is not indicative of future performance, but if they have a bunch of regulatory issues, it might mean something. And those are all privy to the public directly from the SEC website, which is BrokerCheck, which we'll have the link later in the presentation.
Welcome to your personal financial website, the window into your financial world, where you can see up-to-date information on your accounts, net worth, investments, goals, spending, and more. Start in the organizer. Enter your essential details, upload photos of your family members and personal possessions, and connect to your financial accounts, all for a clearer picture of you. In the Goals tab, add your financial goals, track progress toward funding those goals, and visualize how your goals impact your long-term financial outlook. Monitor your daily cash flow transactions and create budgets to help you stay on track, all from within the Spending tab. Learn more about your asset allocation and see the current values of your holdings from the Investment section. Here you can drill down into your asset types for a detailed breakdown of each of your investments. The Vault is your secure digital document storage repository. Upload all your important and legal documents so you always know where they are and have access to them anytime from anywhere. Your personal financial website is filled with features that allow you to take control of your financial life, so take the time to explore. And if you need help, it's always just a click away in the top right corner of the page.
Our dashboard is available to all of our clients, including any clients that you introduce to us. And this is a great way to link up any old accounts that they might have in the US. For example, old 401ks, old investment accounts, et cetera, and that might bring an opportunity to consolidate them to being under your management. Using all those other tools together, most of our clients have found great ways to get more organized and to set up a better financial plan for themselves. We also have some other resources for you. One of the best, I'm lucky enough to be on their advisory board, is American Citizens Abroad. And we'll have the link right here on the website, but Mary Louise has put together a nice little video, so I'll let her introduce the organization from here.
Welcome, everyone. My name is Mary Louise Serrato, and I'm the Executive Director of ACA, American Citizens Abroad. I wanted to talk to you a little bit today about our organization. American Citizens Abroad has been advocating on behalf of Americans living and working overseas for over 40 years. We are nonpartisan, and we are a qualified 501c4 nonprofit organization based here in Washington, D.C. As part of our structure, we also have a educational and research branch of ACA called American Citizens Abroad Global Foundation, or ACA-GF, which is a 501c3. So a couple of things you should know about the organization. Being nonpartisan is very helpful to our advocacy work, because when we go up on the Hill and advocate for the issues facing Americans overseas, we have no political interest. And having two qualified nonprofits is very important, because the offices we're meeting with, the stakeholders that we're partnering with, they understand who we are, they understand our structure, and that is really important for credibility in advocacy work. So what are our issues? ACA has for over 40 years advocated on a wide range of issues affecting Americans overseas. Everything from citizenship, voting, taxation and compliance, and access to government services or programs such as Social Security, Medicare, even dealings with the U.S. State Department. Had much success in being able to influence certain regulatory policy on things like FATCA and on the streamlined compliance program. So our work has been really effective, and we have had many successes. Take a look at our accomplishments on our website and you'll see. We've also been a real resource for the community and continue to be a real resource to the community with things like our directory of professional services and access to U.S. stateside banking services. So thank you all for listening and learning about ACA. Again, I encourage you to visit both our websites, both American Citizens Abroad and American Citizens Abroad Global Foundation. Thanks.
Thanks, Mary Louise. A couple other resources that will be helpful. You'll get this in the follow-up email. Is a copy of our American Expat Guide. This is written out versions of most of the things that we talked about today so that you don't have to try to put them to memory, and a great guide to be able to hand to clients to say, these are some of the things, some of the problems that you need to watch out for. As I promised, here's an outside resource on views on PFICs and how the passive foreign investment company rules can affect Americans. And if you don't believe us, put it into Google. You won't find many nice things to say about that. Another directory to find professionals that work with Americans. Naturally, you don't just need a financial advisor that deals with them. You might need an immigration lawyer, an accountant, a real estate agent, mortgage broker, whatever else in between. So the US Expat Directory is a wonderful source to use those. You should always use BrokerCheck to check on the backgrounds of anybody that's dealing with Americans. I promise you your clients are already doing so. The double taxation agreements between the US and any country you're dealing with are all readily available on the IRS's website. And there's great short versions of exactly what the interpretations are, because some of the jargon inside of these DTAs is quite cumbersome and hard to understand. A few articles about our new program that we have with Praemium. If you have direct access, if you already have terms of business with Praemium, you can access all of our portfolios directly there. And so you don't even have to go through us, but always, whenever you have questions, please reach out to us. Here's our team. You can reach out to any of us at any given time. I'm going to hand it back to Cam for the Q&A at this point in time.
Perfect. I think that was the only question we had for now. Again, any questions, please feel free to email us later on. But once again, thank you very much for attending our webinar, ladies and gentlemen. We will be sending out follow-ups, again, with a copy of the slides and recording to view in your own time. And we will be ending it here now.
Thanks for joining, everyone. Thanks for hosting, Cam.
Thanks, guys.